Mic check.
Oh, good morning, everyone. Remember me? Oh, good. Not that long. All right, welcome to today's proceeding of Docket 250602, GennConn Energy application to establish a revenue requirement. Commissioner Michael Karen, upon a vote of the panel assigned to this docket, has been named as presiding officer for the proceeding. Okay. Why don't we go ahead and take appearances?
Good morning, Commissioner Karen. Brendan Vaughn from Keegan Whirlin on behalf of GennConn Energy LLC.
Before we go further, I'd like to note that through filed correspondence, there's disclosure concerning the prior involvement of some of the asking parties. So is there any objection for this proceeding for the current panel as presented? Oh, I'm sorry, you're still doing appearances.
Sorry, Allison McCorney for the Office of Consumer Counsel, joined by my co-counsel Andrew Minikowski, and there's no objection from the Office of Consumer Counsel.
Yeah, there better not be. Anyone else?
Good morning, and I should say, good morning, Chairman Wheel, Vice Chairman Arconti, and Commissioner Beecher. No, the company has no objection and appreciates Chairman Wheel's disclosure. I checked with Mr. Hurwitz, and that summation of the pre-filing meeting was accurate. We appreciate the transparency and the filing. We have no objection.
Very good. Very good. So does the company have any opening remarks before they introduce the panel?
We have no opening remarks, Commissioner Karen. I do have a few administrative matters that I just wanted to
Let's address
on the record, if that's appropriate.
Shoot.
Just to flag for the record, I believe we have 3 pending motions for protective order filed on June 27th, September 16th, and October 14th. Those cover several different attachments. So just to the extent that there are cross-examination questions on those attachments, I would ask that we, if we need to get into anything that's confidential, we do that on the non-public record. Just to put that out there. And we did notice during our preparation that there was an interrogatory number that was used twice for 2 different questions. There was an RRU 32 issued on September 2nd that asked about the reasons why the company would be unable to file on or before May 1st of a given year. And then there was an RRU 32 issued on October 1st that asked about the transmission GIS expense. Both were responded to before we noticed that issue. So I guess if we're asking about RRU 32, if we could just clarify whether we're speaking about the one issued on September 2nd or the one issued on October 1st. I'll defer to the cross-examiner on that, but just for the clarity of the record, if that question comes up, I wanted to flag that there were 2 of those.
Sure. If it comes up, either the cross can, whoever's crossing can clarify the date and or the respondent as well.
Great. And then our last procedural or administrative matter is consistent with what we've done in prior rate cases. We were wondering, this is analogous to a rate case, I suppose. So we were wondering if we could reserve late file Exhibit 1 for any updates to attachment GennConn 2, which is the company's proposed revenue requirement. That was updated in discovery as RRU 35 attachment 1. But we've flagged a few updates that I think will be discussed during direct examination, and to the extent any others come up, we were thinking LFE 1 would be a good reservation for that, if that makes sense.
Sure. Is there any objection to the request using a late file Exhibit 1? Seeing none? Okay, so we'll do that.
Thank you. And that's the last administrative matter, so I believe the
All right.
panel is ready to be sworn.
Well, then if you wouldn't mind introducing your panel, and we'll administer the oath.
Absolutely. To the panel members, would each of you please state your full names and positions for the record?
Melissa Dorsey, Tax Director, Avangrid Service Company.
Jacob Hurwitz, Senior Director of Revenue Requirements, here on behalf of GennConn.
Devang Patel, Senior Vice President, GennConn Energy.
Chad West, Plant Manager, GennConn Devon and GennConn Middletown.
All right, if the panels wouldn't mind raising their hands. Do you swear that the testimony you provide is the truth, the whole truth, nothing but the truth, so help you God under pain and penalty of perjury? Very good. Wouldn't mind adopting your testimony.
Thank you. Mr. Patel, Mr. Hurwitz, and Mr. West, as part of your preparation for this docket, did you provide pre-filed direct testimony and exhibits which were marked as attachments GennConn 1 through GennConn 10, GennConn CP1 through GennConn CP3, and GennConn EP1 through GennConn EP5? And do you have any updates to your initial testimony attachment GennConn 1 since it was filed on June 27th, 2025? And to the panel, did each of you also sponsor responses to interrogatories submitted in this proceeding? And do you have any updates or corrections to your pre-filed testimony or interrogatory responses not previously identified for the record in an interrogatory response?
Yes.
Mr. Patel, could you please explain that update?
Yes, relating to RRU 35, we provided an update to attachment GennConn 02. While preparing for this hearing, I recognized that RRU 35 GennConn attachment 1 inadvertently did not identify and include all of the revisions associated with RRU 7. Specifically, as indicated in the response to RRU 7, the revision associated with depreciation of intangible assets. Additionally, on October 28th of 2025, Bureau issued its final decision, docket number 241004, which is the application of United Illuminating Company to amend its rate schedules, setting UI's authorized return on equity at 9.45% before any reduction. Consistent with past practice from Bureau, for mid-case changes in approved return on equity, the company will incorporate this update into LFE 01. This change the formula ROE for GennConn be 10.025%, which is the average of the 9.45 for UI, the 9.25 for CLNP, and the approved 0.67.
Thank you. And subject to the corrections identified above, do you adopt your pre-filed testimony and interrogatory responses as part of your sworn testimony in this proceeding? Thank you. The panel is available for cross-examination.
All right, with that, staff is ready. Please proceed.
Sorry, Commissioner Karen, thank you. I believe the witness's microphone is not on. If you can just make sure it's on when you give testimony.
Apologies and thank you.
Sorry.
And just for clarification, we have had some indication that not all the court reporters can hear all the answers clearly, so just bear that in mind and try to. I wish we had more microphones. Maybe we'll try and work on that in the coming year to provide better audio here. But
We'll do our best and
Okay, very good. Thank you.
please don't hesitate to tell us if we're not loud enough.
Good morning, commissioners. Good morning, team. So starting off, I'd like to look at RRU 35 Attachment 1, GennConn 02 revised. This is going to be a question on FERC account 553. Let me know when you're ready.
Just a moment.
I would also, it may be helpful to have the final decision from last year, 240602, open and turn to page 23 as well.
What was the page reference again?
23.
And Mr. Rowe, I heard you reference a specific FERC account within the attachment. Was there a particular page or tab?
Yes, sorry. It's going to be Exhibit 7, Devon.
You have it? Okay.
We are set. Thank
Okay.
you.
Okay. So for Excel line item 19, the item, would the company be able to itemize the 2024 adjustment column E, Excel column J for generator testing, SCR, and NERC expenses?
So you're referring to column E?
The total amount displayed in the cell should be $155,014.
We do have that information. It will just take us a little bit to pull it up. Maybe a read-in. If, depending on how long this goes, we may be able to get it by the end of the cross-examination, but we don't have that at our fingertips now.
Okay, that works.
Okay, I'll be reading A.
All right. I'll move on to my second question then. So next, I'd like to pull up response RRU 34. And the final decision, it may be helpful to have page 25 pulled up.
Just a moment.
Let me know when you're ready.
That was 34, you said?
RRU 34 and final decision, page 25.
Thank you.
PDF is crashing. We are there.
So in the company's response to RRU 34, the company states that $23,958 in costs related to the NERC relay expense. And the company cites pages 25 through 28 of the final decision. Where within the pages of the final decision can this $23,958 be found?
The exact number, 23,958 that you're talking about is really the reconciliation of the actual expense that occurred. I think if you see the discussion above it, the breakdown of values refers to dollars that have already been approved and recovered and reconciled to actuals. So you wouldn't see the reconciled amounts in 240602. It's just a result of what we've already received approval for, collected in 24 and reconciling to actuals.
Okay. So is that a difference of estimation versus actuals?
Correct.
Okay.
Yes.
I'll move on to question 3 then. For this one, Exhibit GenCon 08 and Exhibit CP2, and let me know when you have those pulled up.
We're there.
So in Exhibit CP2, there appear to be 2 speed probes purchased in invoice number I-79051 dated November 2023. However, in Exhibit GenCon 08, the company states no speed probes had been purchased within the prior year in tables 1 and 3. Can the company explain this discrepancy?
You're starting with GenCon 08 or in CP2?
So CP2 has the invoice I-79051, which looks like there were 2 speed probes purchased on that invoice. And then in Exhibit GenCon 08, tables 1 and 3 seem to show that no speed probes were purchased in that year.
Sorry, do you have a page number on
Yeah, let me see if I can find
CP2
that.
for that invoice, please? Thanks. Is it maybe page 21?
Yes.
Thanks.
So this was purchased in. Okay, please repeat your question again.
So on page 21, which displays invoice I-79051 in GenCon CP2, there appear to be 2 speed probes purchased. And then in GenCon 08, the first and the third tables seem to state that there were no speed probes purchased in 2023.
Just confirming with the plant manager, it just appears that we didn't add it to the table and it should have been added to the table on the response.
Okay.
Yeah.
Do you need that answer revised?
I was waiting to hear from the company. I think you said that you were double checking or,
No, I just indicated that it was just inadvertently left out of the table.
okay,
Yes.
sorry.
Yeah.
Okay, I'll follow up then. I have some more questions on the subject matter. So, and I apologize, I didn't note the numbers for these next couple invoices, so we may need to take a second to identify them for the page number. But invoices, I'll start with this one, I-110-315, which, let's see if we can.
Would that also be in CP2?
Yes, sorry, apologies. It looks like it's the first invoice and, nope, never mind. It's listed first, but
Is it page 19?
Thanks.
correct. So I'll just note that it states that, or it appears, and if we could get confirmation from the company that another speed probe may have been purchased in this order.
Okay, and your question was on this?
So there are going to be two more invoices, but which I believe will not get us to the totals shown for the 2024 calendar year for speed probe purchases
Mhm.
at GennConn, Devon and Middletown. And so I'm wondering if the totals reflected in that invoice 109,932, 101,973, which I believe are all in 2024, in which the company states that there were 0 purchased at the Devon facility in 2024 and 2 purchased for the Middletown facility. Between the 3 invoices, I believe there's a discrepancy, or I should say, is there a discrepancy between CP2 and GennConn 08?
Yeah, I think, it seems as though the tables on GenCon 08 is missing some of what's reflected on the invoices. And I would suggest that we just update GenCon 08 for the record to reflect the appropriate.
Yeah, it's a late file.
Yes.
Yeah, I'm okay with that.
At late file 2.
Sorry. They filed two, I'm sorry, could you give me, that was?
Have it as just
I
revised.
wrote it down as update GenConn 08 to reconcile to CP2. Does that make sense to everybody?
That works.
Thanks.
And when the company's ready, let me know and I'll ask my next question.
Right.
So I'd like to refer to response RSR 31 and the company's pre-filed testimony at page 25. And this is in relation to the chiller safety rail project at the Devon facility. Exhibit EP3 as well may be helpful.
We're there.
Okay. So in table 13 of the company's pre-filed testimony at page 25, the company states that the safety rail project at the Middletown facility is the only safety project they are seeking review of this year. However, the company goes on to state at page 27 that $16,441.71 of project costs for the GennConn Devon facility were included in 2024 actuals and submitted as part of EP3, and that the remaining balance will be included as part of the 2025 actual costs in the company's 2026 revenue requirements filing. Just for confirmation, is the company filing the Devon safety project or planning to file the Devon safety project for review in next year's docket?
My apologies, Mr. Rowe. I was looking for the first quote you referenced about the chiller roof safety being the only safety project. And I'm just trying to
Yes.
scan quick, but I'm not seeing that on page 25. Am I?
Yeah, let me see. So it was the table showing that the company had filed was only requesting the amount for the Middletown project could be found in table 6
So you were
on the page. And then at the end of page 27, there's some language about the company's plan as to what was included in this proceeding for costs from the Devon facility.
I see. You were identifying that this was the only such project in the Middletown column of that table.
Yes, and I'm confirming that on page 27, the company included $16,441 of costs for the incomplete Devon project. Response RSR 31 restates a lot of the same language if that would be easier to reference.
Okay, just rephrase that question and I'll go from there. Yeah.
Yeah, so the $16,441 from the Devon project
Yes.
that were submitted in GennConn EP3 for the invoices and included in 2024 actuals. Is the company planning on submitting the completed project for prudency review in next year's docket?
The balance would be submitted as part of 25 actuals, yes.
So there will be the company plans on providing a submission for review in next year's docket.
Yes, we would.
Okay.
Mhm.
That concludes my questioning.
Thank you very much.
Mr. Rowe, we found the information from Read in A, if that would be helpful.
Yes.
So you were asking about a balance of approximately 155,000 reflected on a certain tab in the model. There are 3 primary components of that balance. One is an SCR coupon and analysis major maintenance expense with an amount of $38,424. There's generator.
Can I have that number one more time? I'm sorry.
Yes, $38,424. Second is generator testing major maintenance expense in the amount of $92,632. And third and finally, NERC relay and trip testing in the amount of $23,958.
Can I have that amount one more time?
Of course, the third amount was $23,958.
Give me 1 second. I may have a follow-up.
Take your time.
That'll be all.
Okay, thanks very much. Mr. Capozzi, are you up next?
Yes, I am. Thank you. Thank you, Commissioner Karen. Good morning, commissioners. Good morning, panel.
Good morning.
So my questions this morning are about the SCR catalyst replacement liability. And let's start with RSR 22 attachment 2, please. Page 1.
It's attachment 2. Did you, 1 moment.
RSR 22 attachment 2, right?
That's correct.
Okay.
Page 1.
We're there.
Okay, thank you. So my first set of questions are about cost estimates for the potential SCR catalyst replacement. Can you explain the categories of costs on the left, in the left column?
I will do my best. And the categories of cost at the time when we were evaluating what it would take in order to replace the catalyst, really just categorized it in these separate components. The catalyst itself, the oversight and field services and resulting performance testing, and the removal installation. I think if we refer to the other interrogatories asked about the SCR catalyst, we detailed out in greater detail what it would take in order to replace the SCR catalyst at the site. But at the time, these were the categories that were defined. And this was resulting in my review of this based on proposals that we had received from the various contractors that these are the critical elements of the replacement.
Thank you. So if I'm looking at the top row on the left-hand column, SCR catalyst cost,
Yeah.
and then jumping down to the fourth, I see CO, VOC catalyst cost. How do those differ?
It's just differs by the contractor that bid. It's the Miratech versus Cormtech that bid proposal.
So those would both be the actual catalyst cost replacement, or are they different components?
So So the difference between those two line items, between the Chromatech and the Miratech, that would be two different vendors that we had went out to receive quotes to replace that catalyst. It's the same thing, the SCR and the CO catalyst. It's just getting two different bids from two different vendors on the replacement cost.
And that would be would that be the same for the column, the removal and installation would be the same type of work as the field service, or I'm sorry, as the SCR? I'm seeing two columns for removal and installation, one for Day and Zimmerman and a separate one for Day and Zimmerman.
So the difference is there is they're quoting out replacing the CO catalyst versus the SCR catalyst. So if we just needed to do the CO catalyst, it would be the price that is listed there.
So would the CO catalyst, if I'm looking at the one of the two bottom rows, CO/VOC catalyst, would that be a subset of what's labeled above as the SCR catalyst?
Correct. Yeah, it's two different catalysts in there. You got the SCR catalyst and you got the CO catalyst in there.
So the SCR catalyst would, if I'm looking at a SCR catalyst row, that would include CO/VOC catalyst?
It would.
And the opposite, and the CO/VOC catalyst would not necessarily include everything that's in the SCR catalyst.
Correct.
Okay. So then if we scan over to the columns, for example, column 2021, that number at the bottom, that 2.007 million, we're just adding all those rows, is that correct?
Yes, it seems that way.
Okay. Should we be adding all those rows based on the discussion we just had?
I think it's a reflection of, there are catalysts for each of the 4 units on each site. And I think this is just a reflection of needing to replace the CO catalyst or CO and SCR catalyst by unit, if you will. But if you add it up together, I would assume at the time, this is how it was analyzed and number put together.
So how many units at each site then?
There's 4.
So then, so are we assuming that the CO/VOC catalyst, would that be spelled out? So this is the page 1 of this exhibit. Would that be spelled out in subsequent pages where the actual the estimates are developed?
Let me just confirm by looking. I think we'll need a little time to review and just come back to you. I think the item submitted reflects work that was done in 2016. So we're wanting to make sure that we characterize properly.
And just one moment.
So that's going to be a read-in.
Yeah, we'll just add that the table up front is just a reflection of, information at the time, but doesn't establish the liability in and of itself that we have for the SCR. That's defined in a different way. It's just, this process was an effort to understand at the time what it would take in order to replace the SCR and CO catalyst, just to give us a framework for going forward.
Thank you. The purpose of the liability is to support eventual replacement of the SCR catalyst. Is that correct?
That's correct, yes.
So can you elaborate more on the distinction you're trying to make between this exhibit and the liability itself?
Yeah, so in an effort to be responsive to this, this interrogatory, our effort kind of came up with the work that was done in 2016 to reach out to potential vendors to understand what the potential cost might be to replace the CO and SCR catalysts. That's just a point in time that says, okay, if we were looking to do this now, where would our cost potentially be? But it has no relationship to how we established the SCR reserve for the potential replacement of the SCR and CO catalyst from the outset of the GennConn facilities.
Should the SCR reserve, the liability balance be, should one factor that the company considers for that the eventual replacement cost of the SCR catalyst? Did that make sense?
No, I was thinking about that. Maybe you can ask that question.
Yeah. Does the company consider the eventual replacement cost when determining what an appropriate SCR replacement liability balance should be?
Yeah. So I think in several responses that we talked about the SCR and the reserve, we did file in one of the responses, I think we're looking up the reference to it now, what was the original basis for developing the SCR reserve. And it was related to the VOMH rate for variable costs associated with this. And the reasoning for that at the time was the SCR catalyst and CO replacement is really dependent on unit operation, right? Once we're dispatched and the unit operates and the number of hours that they operate is what would cause the SCR and CO catalyst to be impacted. And at the time, back in 2009-10, when the GennConn facilities were first developed, we knew that this would be a major item, and with the assumption of a 5% capacity factor translating to potential operation of 438 hours a year, and then so on. So based on that analysis, we had anticipated a need to replace the SCR and CO within the 30-year time period of the GennConn facilities. So in 2016, related to this question that we're talking about, it was just trying to understand at that moment in time, are we, what would the potential cost be? Not really considering what the reserve balance is necessarily, but it's just an effort to know whether or not this makes reasonable sense or not. So.
Okay, thank you. A few more questions about this exhibit, page 1 of this exhibit. So looking at the Cormatech proposals received in 2016, sorry, pulling the exhibit back up. To get to the final 2021 and 2022 columns, the company is just escalating those 2016 estimates by 2.25% each year. Is that correct?
Yes.
Okay, and similarly for the 2019 proposals, the Day and Zimmerman and the Miratech proposals, the company is escalating, similarly escalating those by 2.25% each year from 2019 to get to 2021 and 2022.
Yes.
Yeah. Thank you. So the most recent estimates we have according to this exhibit, are $2.007 million for the Devon units in 2021 costs and 2.052 for the Middletown units in 2022 costs. Is that correct? Those are the most recent estimates we have.
Yeah, based on the, work that was done in 2016 and
Right.
thereafter, yes.
Okay, thank you. So the total costs for all units at both facilities is 4.06. Is that correct?
Give or take.
Give or take,
Give or take.
roughly. Okay, thank you.
I will note that if we go through this process now, given all the financial conditions we've had over the last couple of years and so on, these numbers could be significantly different.
Okay, thank you. What is the projected balance for the SCR Catalyst liability as of year-end 2025?
Projected balance.
I believe subject to check that's presented on, I've got RRU 35 attachment 1 open. I suspect this could also be found in GennConn 2 or the forthcoming
Yes.
LFE 1, but I'm looking at Exhibit 1, pages 1 through 6, the tab with that label, Excel row 39, and you can see a 2025 balance of approximately 3.9 million. And I'd also add to my colleague's answer from earlier, the pre-filed exhibit he referenced was GennConn 3.
Okay, thank you.
You can see that this balance is a reduction to rate base.
That's right. Thank
I
you.
interrupt. I just want to encourage Mr. Hurwitz to keep his voice up because we
Thank
got
you.
the fan going, and be confident. You got this. Speak louder.
Thank you.
I will also add, thanks, Mr. Hurwitz, that 3.9 million estimated for or reflected here at the 25 balance is really associated with 438 hours of operation potentially in that year. So that number will change, obviously, based on how the units operate totally in 2025.
Okay, and the company will reconcile that in next year's proceeding?
Yeah, it's just a reflection of what the actuals will be in 25.
Right. Okay. So if the costs, the most recent estimate of the cost to replace the SCR catalysts are about 4 million, and the reserve balance is approximately 4 million, or just under 4 million by the end of 2025. Can you explain the justification for continuing to accumulate more to the reserve in 2026?
So, yeah, go ahead.
I think there's a couple points that are important to recognize here. One is you would hate to find yourself in a circumstance where GennConn is short at the end of its life, where there's a check due to GennConn because this was under accrued. I think we also heard my colleague, Mr. Patel, describe that these are based on estimates. The estimates reflected in the data request we've been discussing are now several years stale, escalated by a 2.25% inflation rate for every year since when the estimate was received. And today, the actual inflation rate has exceeded 2.25% in recent years. So based on that alone, all else equal, you may expect the actual cost to exceed these amounts. Also, as my colleague, Mr. Patel, described, the $3.9 million estimate reflected in RRU 35 attachment 1 presumes 438 hours of operation per year, which may be more than GennConn operates in 2025. As illustrated in GennConn 3, the actual amount the regulatory liability will grow depends on how much GennConn actually runs each year.
Okay, thank you. But it's correct under the proposal, the company's application that in rates for 2026 is an accumulation based on 438 hours of running time, operating time.
After the historical test here in this case. So as
Right.
my colleague, Mr. Patel, described, next year we will reflect the actual operations of the company in 2025. It's the same thing in this case, just 1 year removed. We reflected the actual balance in 2024 and then jump off that with the 438-hour assumption.
Okay, thank you. I'd like now to turn to RSR 23, GennConn attachment 1, please.
We're there.
Okay, thank you. So I'm looking at, I believe I'm starting on the, excuse me, the SCR accruals sheet.
Okay. Yes.
So Excel column F shows the Devon operating hours, and Excel column L shows the Middletown operating hours since the start of their commercial operation. Is that correct?
Yes.
Okay. So if I add up the entries in those columns, I will get the total operating hours for each plant through 2024. Is that correct?
Yes.
I added up column F for Devon, Excel column F, and I saw 3,486 operating hours. Does that sound correct, subject to check?
Yes.
And same for Middletown, Excel column L, I saw 2,702 operating hours. Does that sound correct, subject to check?
Yes.
Okay. I see Devon began operating in June 2010. Is that correct?
Correct.
Middletown in June 2011. Is that correct?
Correct.
Okay, thank you. So Devon is about 14 and a half years of operation through 2024,
Yes.
and Middletown is 13 and a half years of operation through 2024.
2010 to 25, close to 15 years. Yeah.
I thought Middletown was started in 2011.
Devon is 2010. Yes. Middletown is 2011.
So 2011, June 2011 through the end of 2024 is 13 and a half years. Is that correct?
Yeah.
Subject to check.
Subject check.
I'm checking because I don't trust my own math.
Yeah.
Even
Yeah, I'm just
that.
going from 2010 to 25. I said, okay, it's 15 years.
And the SCR catalyst replacement reserve assumes replacement at about 12,000 operating hours. I believe that's in the testimony. Is that correct?
Yes, that's generally the OEM type recommendation. Yes.
And that's 12,000 operating hours separately for Devon, the units at Devon, and separately for the units at Middletown. Is that correct?
Each and every unit. Yeah.
Okay, thank you. And so when determining the annual accrual, the company also assumes there's a 5% capacity factor of yeah.
For forecasting purposes.
Yeah, that's right. Okay. And so, and I think in an interrogatory response, you indicated that 5% capacity factor is 438 hours per year, correct? Okay.
Yes.
Has the company analyzed the historical operating hours for each plant and each unit to see if they meet the 5% capacity factor?
This little narrative in my head and then I forgot your question. Could you
Yeah.
please just repeat it?
Yep. Has the company analyzed the historical operating hours for each plant and for each unit to see if they meet the 5%, if they have met or meet the 5% capacity factor assumption?
We did not undertake the exact exercise that we just went through together, but we had contemplated whether it would make sense to propose something other than a 5% capacity factor as the basis for how we calculate going forward accruals for revenue requirement purposes. Ultimately, we chose not to because as I mentioned earlier, the regulatory liability for SCR Catalyst is a reduction to rate base. And if we were to change the 5% assumption, it would in all likelihood be a lower assumption, less than 5%. And if we were to reflect that in our going forward calculations, that would mean we would have less assumed regulatory liability, higher assumed rate base, and customers would pay more. So we opted for the conservative choice of continuing the 5% and going with the marginally lower rate base than we otherwise would if we had proposed a change.
Okay. Okay. I think I want to get back to that. I just have a few more questions. So my analysis of the historical operating hours on the SCR accrual worksheet, I divided the total operating hours by the total years in operation, which we just discussed. So subject to check, would you agree that Devon has averaged about 240.5 hours per year and Middletown has averaged about 200 hours per year? Does that sound correct, subject to check?
I found 239.1 and 198.9, which are
Okay.
pretty close to
Okay.
what you said.
Thank you. And these are about half the assumed half of what the assumed capacity factor is, give or take, a little more, a little less.
Approximately,
Okay,
yeah.
thank you. That doesn't factor in each unit's runtime though, does it? Those numbers? Each unit within, for example, each unit within Devon, for example, that's just the total for the total plant, okay?
Yeah, it's correct. It's total
Okay.
plan.
Do you know do you have each unit runtime? I don't think we need it.
Yeah, I mean,
Necessarily.
that data is available, but we'd have to.
Do you know if units operate generally at about the same rate? Or,
I think generally our experience has been that the units get dispatched in somewhat of an equal fashion throughout the year. I mean, some units may be more than others, but we want to be able to exercise each of the units, right? Not have any single one sitting there idly for any length of time.
okay, thank you.
I'm sorry to interrupt, but I wouldn't mind seeing the runtime data if we could potentially turn that into an LFE.
Well,
Yeah.
so this would be late file number 3. We run
Individual unit runtime, is that sufficient?
unit runtime.
So unit runtime for each plant, I'm supposing, right? So-
Yes, sir.
Yeah, yeah. And do you need that for the entire life of the assets, or are we just looking for a couple of years, or are we
Do we do an average over the last 5 years?
average over the last 5 years?
So
Yeah.
2019 through 2024.
Yeah.
Yeah. Commissioner, I'm sorry to interrupt, but I would recommend I think it's simple enough to just get it from the start of operation.
Okay. Start of operations then. Thank you, Mr. Capozzi.
Yes.
I think the last point I would add for consideration, which I don't mean to disagree with the late file, and we're okay taking that, but market conditions can change over time, and how the market operates in 2023 or 2024, or how you'd expect it to operate in 2025 or 2026 may or may not bear resemblance to how markets were in 2009, 2010, 2011. So I think that would be another factor to be contemplated.
Thank you. Just a few more questions. Based on based on the 5% capacity factor, the company, and I believe this was in an interrogatory response, the company assumed replacement based on that 5% capacity factor, replacement would be targeted at 27.4 years. I think that's correct. Is that correct?
That's correct.
Okay. However, if the operating time is about half that would be more like the replacement time would eventually be 50 years or more. Is that a fair assumption if you're looking at historical operating time of the units?
Yes.
Okay. Okay. The company, there could be other factors for replacement of the SCR catalyst. Is that correct?
Yes.
Yeah, okay. Has the company has tested the SCR catalyst for both plants, correct?
Yes.
Do you recall when the last test was done at Middletown? What year?
Our plant manager indicates that he believes it was done in 23, but he'd have to check.
Okay, and Devon was tested. Do you recall what year Devon was tested?
That unit was tested in 23 also.
Okay. Thank you. Did either test results indicate the need for a replacement, SCR catalyst replacement at this time?
Not at this time. It's showing about 90% of the life left on the catalyst at this point.
9% of the life left?
90%.
Oh, 90, okay. At what percent would you target replacement? 0 or 50 or?
So the OEM recommends that once we hit 85% or below is when the recommended replacement is.
Okay. Okay. And that was about 90%, or do you, I believe the test results were submitted as an interrogatory response, but I had trouble finding, I don't recall seeing that number. Do you remember the exact percentage of each one, or?
I can get you that number. I'm not sure exactly what the exact number was for all the test coupons, but I can get you that number.
Okay, thanks. I would like to request a late file.
Late file. And you're looking for residual life for the SCR catalyst? Residual percentage of life?
Yeah, I'm not sure how you would name that, but, and could it be provided for each unit within each plant?
It can be.
Okay, so I would request, yeah, the residual life for. I want that.
It's late file exhibit 4.
Just to make sure I understand exactly what you're seeking, you're seeking the actual value of the 90% by unit.
Yeah. Is there a name for that? What we would call that 90% value?
It's they refer to that as the removal efficiency from the, for the
Okay.
NOx and the CO. So it's
Removal frequency, you said?
removal efficiency.
Efficiency, okay. So the removal efficiency for each unit at each plant. And the date, I think just make sure we have the date when those results were too. Thank you.
That's date of testing.
That's right.
All right, late file exhibit 4.
Thank you. Okay, there is a potential that, under the scenario where SCR replacement would not occur outside the 30-year contractual life of GennConn, what would be the justification for maintaining the regulatory liability?
I'll start and then let my colleagues add to it as they see fit. I think as I mentioned earlier, it would be unfortunate, I think, from everyone's perspective, if we found ourselves in a situation where replacement was required and we didn't have the money to cover it. So we're trying to avoid that circumstance. The money that has been recorded to this regulatory liability is used as a reduction to rate base. So it's not like we're profiting off of that. I would also add, I see where you're going with the runtime thing, the 12,000 hours and the 27 years versus 50. But I think the counterpoint of that is what we just heard, that if we're at a 90% removal efficiency as of a couple of years ago, and the original equipment manufacturer recommends replacement at 85, that data point would suggest that we're 2/3 of the way there, and we're less than halfway to the 30-year life or about halfway to a 30-year life for the facility. So I think it would be risky to assume that this will not be required, and you would hate to find yourself in a situation where you're short when replacement is required.
Thank you. Understood, but under the hypothetical scenario where an SCR catalyst does not need to be replaced, how would the company propose to return the accumulated liability to ratepayers?
To our knowledge, that's not something that's been contemplated. Presumably, we would address that in whatever year that became apparent and address it in the proposed revenue requirement in that proceeding. But to our recollection, sitting here now, that's not something that's been previously contemplated.
Okay, thank you. And I think I have one more request. Can this will be a late file request. Can the company provide updated exhibits showing revenue requirement and rate base impacts under the scenario that accumulation to the SCR catalyst would end by December 31st, 2025?
And to make sure I follow your request, I've pulled up, I have RRU 35, but I think this was the same in GenConn 2. And I've pulled up one of the exhibits that reflects this regulatory liability, and I see that we have a balance in 2024 of approximately 3.3 million, a balance in 2025 of approximately 3.9 million, and a balance in 2026 of approximately 4.5 million. You're asking for us effectively to make the 2026 balance equal to the 2025 balance?
That's correct.
I'm sure that could be done.
Okay.
Okay, late file exhibit 5.
That's correct.
Maybe just a clarifying question. The balance that is present in the 25 interim year represents 438 hours of operation. Are you suggesting that we define that by taking the average on an annual basis of capacity factor and apply that? Or how do we want to approach?
Do you apply that to get to 2020, the end of 2025? I'm
Yeah,
not suggesting that.
okay.
I'm just suggesting from the start of the rate year, no future accumulations to the reserve.
One suggestion, maybe, the $3.9 million figure for 2025 that I quoted reflects, as was just discussed, the 438-hour assumption. In the alternative for this late file, we could look up whatever the most current balance of this regulatory liability is, and then just hold that constant for the remainder of the analysis. That will result in a number that is not any of the ones in what we filed, but may get you to where you're trying to go, if that's amenable.
Yeah, I mean, I'm not sure where I was trying to go other than just to, I think that's acceptable too. That's totally fine. So that would be fine.
Okay.
And are there other schedules that would be affected by that change?
This balance will appear on a variety of schedules to the revenue requirement. I've picked out Exhibit 1, pages 1 through 6, because that's the summary. There will be, at a minimum, Exhibit 2, pages 1 through 6, and Exhibit 3, pages 1 through 6, the Devon and Middletown equivalents of this. And then some of the SFRs later on in the model will report this same balance. But conceptually, the effect should be this will affect the schedules that present rate base.
Okay, thank you. I'm all set, Commissioners. Thank you, panel.
Thank you. Attorney Church.
Just a brief follow-up.
My apologies. I was just reminded of a point that I should have made. I suspect and I do not know this with confidence, but just to flag it, the approach of deferring amounts based on runtime may be reflected in the contract for differences. So if we were to stop accruing, there may be other changes beyond just the revenue requirement that would be required to effectuate that. We can prepare the analysis like we discussed, but I think that's part of the answer to your previous question. So I just wanted to say that.
Would those be included in the link file?
What we can put together is a mathematical illustration of what you're saying, but that would not be all of the legal and regulatory changes necessary to effectuate that if that's the direction that were to be gone.
Can you include then a supplement describing those legal and other,
Yeah, we could do a
contact.
more fulsome review of what that would entail.
thank you.
Attorney Church.
Thank you very much. Mr. West, I believe you mentioned the OEM recommendations of 85%. If the SCR catalyst is at 85% or below, that's the recommended time for replacement. Is that correct?
That is correct.
Are those OEM recommendations in the record in this proceeding?
That will be in the test reports that I'll be getting and, for the late filing, but those are laid out in the test reports.
Okay. So those will be coming, the 85% specifically, that recommendation will be with the documents you file in LFE4?
Correct.
Thank you.
Attorney Wheel. Chairman Wheel.
Okay. Commissioner Karen has suggested that I just jump in with some questions now instead of the recent tradition of waiting until the end, which makes sense to me so that we all kind of remember what we were asking about. I just had a couple of clarifying ones. Mr. Rowe was asking about the chiller roof safety rail project as referenced in the testimony. Is that being expensed instead of capitalized? I saw on the testimony it was like described as an expense.
Then it would be an expense.
Okay. This is sort of just sort of like an academic question out of curiosity. And I think is maybe what Mr. Rowe is asking, but because like this, well, I guess backing up, this project's been expensed like over an expansive time. So as we discussed, like some of it is being recovered now and there's some left to be recovered later. I guess just because it's not a capital project, which I'm more familiar with, like Mr. Rowe asked about prudence, right? So more familiar with the concept of when something enters rate base, that's when PURA looks at it and determines, does this make sense? What's the panel's view of like how PURA should be reviewing the kind of incremental necessity and reasonableness of a project if it's kind of being, cut up, like recovered in chunks over time?
Question. You can make a living at this.
And I should have said, this is sort of a legal question. So if it would be better for there to be a late file, or it doesn't need to be responded to now. It's just something, I just wanted to kind of indicate what's in my mind. And I'm just curious like how that can be answered. So I'll defer to the panel and Attorney Vaughn.
Thank you. And as the panel knows, and as you're aware, I'm sure the panel will be providing their opinion as fact witnesses about that. And if there's any legal discussion necessary, we are happy to take that on brief, but I'm sure Mr. Hurwitz and Mr. Patel can respond to your question.
So as you kind of just alluded, I'm not a lawyer, but based on my past experience in regulatory proceedings, my expectation and our expectation and what we filed here is that I forget the name of the project already, but if we incurred $16,000 in 2024, the test year in this case, we're asking PURA to approve that as part of our revenue requirement in this case. The review, I think, could be tantamount to what would be done for a capital project, but the amount of money that we are seeking to recover is the amount that we actually incurred in the historical test year. And then next year, if and when we incur the remainder of the costs in the test year applicable to that case, we would seek PURA's review and approval of those amounts. Again, that could be conceptually similar to how that works for a capital project, but since these are to be treated as expense, we have reflected them in our revenue requirement in the manner prescribed by PURA. And as a not lawyer, I would have anticipated the review following that.
Thanks. And these are, I'll back up again. Because they're sort of like one time, I understand that there are expenses related to a single project that it's spanning over multiple years, but we're not we're not including like the test year level of expense into the ongoing revenue requirement. But in other words, it's being adjusted a la carte every single year, and then when it's done, it'll be off the revenue requirement. Is that correct?
That's right. So to continue the example, if there's $16,000 in this revenue requirement and whatever the remainder will be next year, and then the project is done, in the following year's revenue requirement, I would anticipate the amount related to this project as zero, unlike a capital project, which would linger at the undepreciated value.
Thanks. Two other maybe quick ones. This one,
1 second, I'm being told maybe
Sure.
there's something to add to that answer.
More questions?
We are good. Thank you.
thanks. Mr. Capozzi was asking about RSR 22 attachment 2, page 1. I just kind of looked at it as we're discussing it. And I noticed, I can wait a second for you to open it up if it's helpful.
We're there.
There's discussion about there's the SCR removal and installation line item on page 1, and then there's the COVOC catalyst removal and installation. And I heard the kind of explanation that those were two different things. Is it just a coincidence that 2019 bid is exactly the same number for those two different tasks? The $128,070.
No, that could have been where they had submitted a bid for Middletown and Devon, which is, with the two sites, that's probably what happened.
Okay, so maybe that was like an overall bid that was just divided in half for the purposes of this table. And I understand the testimony about this table being demonstrative and not, but is that probably how that happened?
Correct.
Okay, thanks. And the last questions I had, again, sort of like a broader academic question. I think maybe not getting quite at what Mr. Capozzi was getting at, but I'm not sure, with respect to the catalyst reserve and the liability. Given that this is a contract that will end, sort of unlike theoretically something like an electric distribution company rate base. I think you sort of spoke to this, Mr. Hurwitz, but how generally would the company propose that in the final year of review here, how we should handle any reserve, any liability or asset, sort of to kind of wind down, to figure out sort of how to close this out in terms of the rate impact?
Sitting here now, we can't recall specific prior consideration of that point. I've been reminded by Mr. Patel that there's a possibility the contract gets extended. I would offer, though, that I think in the interest of avoiding rate shock, it may be appropriate to get out in front of that issue and not wait until, I think sitting here today, only halfway or so through a 30-year life, it would be premature to start reflecting this, but maybe 3 to 5 years before the last year, that question becomes more pertinent because I think the SCR catalyst is one example of that. There may be other things that are conceptually similar that would also be appropriate to consider in the wind down of these facilities.
Thanks. Thanks. And the last question on that, if there is a kind of looking at it from the other angle, if there's specific to the SCR catalyst, if there is hypothetically an over accrual after all is said and done, would the company anticipate treating that like how would you handle the kind of truing up of an over accrual of a reserve?
I think it's similar. That's not something that we've contemplated in the past. My assumption would be that if and when that determination could be made, that would be addressed in the revenue requirement proceeding in that year, returning money to customers in the case of an overaccrual, collecting a shortfall in the opposite direction, whatever the case may be. But that's not something that I can recall us having explicitly contemplated in the past.
Okay. Well, good. I feel like these aren't dumb questions then. My last question was relating to the update on direct, for lack of a better word, about the I had a similar question actually about the ROE that was just approved in 24-1004. There was a mention, and this is really just a question that's not angling anywhere, but is there any precedent for, and maybe this is a late file question, is there a precedent for this circumstance where there's an ROE adjustment sort of midstream, and sort of when PURA has implemented it? And maybe that could just be a late file for us to look at or read in.
I may have the answer for you. I think the precedent would be the 2013 revenue requirement proceeding of GennConn, docket number 130638. In that proceeding, GennConn had proposed a revenue requirement that calculated an ROE based on the ROE that was effective for UI at the time of the filing, which at the time GennConn filed in that case was 8.75%. During the course of that proceeding, UI had a rate case decided 130119, and in the final decision in GennConn's rate case, docket number 130638, PURA adjusted the ROE to reflect the change from UI.
Great. Perfect. Thank you. That's my last question for now. Thank you.
Thank you, Mr. Chairman.
Just for clarity of the record, not to testify, that reference, Chairman Wheel, would be 130638 at page 8.
Thank you for the clarification. Commissioner Beecher, any question?
Thank you.
Thank you. Commissioner Carney does not. Any follow-ups from the panel? Thank you very much. Dismissed. And let's call up our friends from the OCC.
Hey, good morning, new commissioners and old commissioners. I am Rory Apollonia. I'm a accounts examiner for OCC, and good morning, company. I know most of you, but new people here, Rory Apollonia, accounts examiner for the OCC. So let me get going here. So I'm going to start first with financial fees. So the first question, I'll be referring to OCC 4 attachment 1. Let me know when you're ready.
We're there.
Okay, great. I see a variance. I see the variances increase related to Fitch and bank fees for 29,207 and 23,390. Let's first start with Fitch. Am I correct to state this is Fitch Ratings, a rating company?
Yes, you're correct.
Okay, great. Are the Fitch fees imposed on long-term debt related to issuances of long-term debt to the market?
Fitch fees are imposed as part of the compliance requirements for long-term debt. We're required to have a private credit rating completed each year.
Okay. So I think I understand what you're saying, but I'm gonna follow up on it. Overall, what is causing this increase in cost for the long-term debt ratings by Fitch Ratings here?
So in this particular case, the 2024 test year represents costs that were actually incurred in '24, but part of this was invoiced in '23. So the 24 doesn't reflect the entire Fitch fee for that particular year, if you will, because some of it was expensed in the previous year. And that goes true for Devon and Middletown because we allocate between the two plants the requirements for Fitch credit ratings.
Okay, so the cost increases are based on timing. Were there, what were or are the annual Fitch rating costs? And I'm trying to look for like each year. So like 2023, 2024, and year to date, 2025.
We can provide some of the details, but I think we've projected the Fitch ratings cost for 2026 at $42,540.
Okay. Moving on to the bank fees in the same attachment, which is OCC 4, attachment 1. What bank or banks is the company using?
So the general banking arrangements that GennConn has is with JP Morgan Chase, where all our operating accounts exists for all of our transactional activity that occurs for the business. And there are fees associated with all transactions and banking, standard banking relationships.
Okay, it's just some follow-ups on that. So do you have like one commercial account with them, or are you able to split up your balances to be FDIC insured?
So there are several commercial accounts, and each plant would have its own commercial accounts, for example. And since GennConn Devon LLC and GennConn Middletown LLC as separate entities would have its own accounts, and then folding up to GennConn Energy, which owns both plants, if you will, the transactional activities that occur by and between the plants, as well as the upstream GennConn Energy companies would have their own individual accounts.
All right, thank you for that. Let's move back to the attachment here,
Mhm.
which is OCC 4. I see that the difference in bank fees is because of a 2024 bank fees being credited out by interest on GennConn's average cash balances. Am I correct with my view here?
Yes.
Okay, great. So moving forward, what was the 2024 cash balances for each month of the year and interest earned each month?
So that's a loaded question. We'd need to be able to analyze the monthly history for what the actual balances were and so on. So
All right, so can I have a late file? And I can repeat my question if you want.
Oh, I would appreciate that.
Okay, yeah, so I'll repeat. My question here is what was the 2024 cash balances for each month of the year and interest earned each month?
Oh, 2024?
Yes,
And what were the balances?
yep. Balances and interest.
And that should reference OCC 4, is that correct?
That's correct.
Thanks.
Thank you. Okay, thank you.
All right, no problem. So moving forward, hopefully you can answer this question. Does the interest earned by GennConn's average cash balances reduce the revenue requirement?
it just reduces the expense associated with these activities.
Okay.
Mhm.
Here's another follow-up question to that. Who gets the interest earned by GennConn's average cash balances here?
So typically the interest earned offsets the bank fees. So it's really the net value that gets expensed. I think moving forward, we've indicated that, and you'll see in the 26 rate here, these values are higher only because they simply just represent the bank fee in and of itself, which no forecast of what the interest may or may not be at that particular, it depends on the average balances, as you say.
Okay, I understand that. One follow-up. I think I understand what's going on here, but so you're saying it's the difference between the fees and the interest? Okay, so you would agree that the interest ratepayers are benefiting from, correct? Because the fees are going down?
Yeah.
Okay, that's good. Now, I'm gonna move on to
I would think so.
different section. I'm gonna go with depreciation, which is my favorite. So we're gonna go first to OCC 5 answer. Let me know when you're ready.
Yes.
Okay. So who authorized the change of useful lives from 30 years to the 2040/2041 in the second quarter of 2025?
Excuse me, change from what?
Okay, yes. So I'm seeing a change of the useful lives from 30 years to it's 2040 to 2041. Let me just quickly get that number for you. Right, it's in the answer. So we have a depreciation expense increase from 2025 to 2026. This is the last sentence of the answer response. It's due to the correction of the useful lives from 30 years to 2040, 2041, in the second quarter of 2000. Okay, I see you're waiting. Yes.
So I'll take a whirl and then let my colleagues supplement as they see fit. We're here changing to match what was approved. What was occurring before this change was new assets installed after the initial construction of the facilities were inadvertently being depreciated over a 30-year life, which if something were installed last year, for example, would have depreciation extending well beyond the end of the expected useful life of the facilities in 2040 and 2041. The adjustment here is to synchronize those amounts of depreciation with the useful life of the facility in 2040 and 2041 that was previously established.
Okay, 1 second. All right, so follow up to that. Would you agree that the sentence, last sentence in OCC 5 is confusing? Going from, I mean, I could expand. We're going from 30 years to now, you're just saying we're gonna end at 2040. So what's the new, we're going from 30 years to what?
It will differ depending on when the asset was installed. It will all ratably depreciate between whenever it was installed and 2040 and 2041. So for example, if if an asset were installed at Devon last year in 2024, you'd have 16 years between 2024 and 2040. If that same asset were installed this year, you'd get 15 years. It's attempting to synchronize with the end of the life of the facility overall. I would give you that there are other ways the sentence could have been written, but we were attempting to communicate that concept.
Okay.
So if I can clarify for myself, so the 30 years was used back in 2010, 2011, 30 years, and now it's been replaced and consequently 15 years? Okay.
That's right. To pick up off of Chairman Wheel's comment from earlier, this is not exactly like a electric utility where you might have some poles that are going to last a certain amount of time and a wire that'll last a certain amount of time. These are two peaking generation facilities. So doing a capital project, just a small scale capital project, is not going to change the 30-year life of the facilities overall.
Okay,
All right, thank you.
please proceed.
Yes. Can you, okay, follow up. Can you get me all the FERC accounts that are impacted with this change?
Not offhand, but I'm sure we could do that via late file.
Okay.
So late file number 7 is you would like to have, you provide FERC accounts that are impacted, right?
Yes.
I just typed out a list of FERC accounts impacted by the adjustment to depreciation referenced in OCC 5. Does that make sense to everyone?
Well said.
Yes.
Yes, thank you. All right, so let's move forward here. What Iowa curves are you basing your useful lives on? So I'll take my best shot at this with the disclaimer that I was not around when the facilities, or I was not a part of the GennConn process when the facilities were first constructed. I'm guessing that your question about Iowa curves comes from experience in rate cases where utilities conduct depreciation studies and they hire consultants to do statistical analysis of when assets have retired, and then they try to fit that retirement data to Iowa curves that then will predict the expected useful life of the facilities. But as we, to some extent, just discussed, the GennConn facilities are not like typical utility property where there's thousands of utility poles with retirement data that could be studied. Rather, they're two peaking generation facilities. To be honest, I'm not sure exactly what the basis was for the 30-year life at the beginning, but
CFD life.
that was the life, I'm being told that was by Mr. Patel here, that that was the life of the contract for differences. So everything would depreciate consistent with that rather than a involved statistical analysis that's typically done in a depreciation study.
All right, thank you for that answer. I'm going to do a follow-up. Hopefully you can answer here. I'm sure you're aware that NARUC has a public utility depreciation practices manual from August of 1996. Did you use that when you first started the depreciation back in the day? And what about now when you changed the lives?
So again, everything goes off of the 30-year life of the contract for differences. I was aware that there are depreciation handbooks. I don't know about that one specifically, to be honest, but everything is driven off of the life of the contract for differences, not a statistical analysis of the company's retirement data, because sitting here on the fly, I think if we were to do that, you would find that these assets have near infinite lives because nothing is retired yet, and that seems plainly inappropriate.
And the contract for differences was essentially a state program that had certain specific things that is, it's not exactly like a rate case that we're dealing with here. So there's some differences and different clarifications.
That's correct.
All right, thank you. So follow up, what is the financial impact of these changes on the spreadsheet? In other words, if it is reversed, what would the number impact be here?
I don't have that total impact sitting here now, but conceptually the impact would be twofold. Number one, it will impact depreciation expense going forward. And second, it would impact accumulated depreciation. I should have identified a third. Those two things together may also affect accumulated deferred income taxes.
Okay, thank you for that. One moment. Okay, are you aware that will there be any salvage value at end of life for any of these assets?
Sitting here now, I'm not aware of an estimate of the salvage value, nor am I aware of an estimate of the cost of removal. And there could be significant cost of removal based on our obligations at the end of the life of the facility.
Okay, thank you. I'm gonna move forward to a different section. This one's gonna relate to ownership. So I'm referring to OCC 24 answer. Let me know when you're ready.
Can I actually just jump in again and
Yes,
it
Chairman.
doesn't work for, thank you. I just had a couple of questions about depreciation before we move on. Again, just for clarification, I think this has been asked 3 times, but the idea is that any new assets that are entering service now are being assigned a useful life that coincides with the original 30-year life. So if there's 15 years left on that original 30-year life now, then 15 is being assigned. Next year would be 14. That I'm getting that right?
That's exactly right.
Okay. And does that treatment apply to every incremental plant addition, regardless of what it is?
Yes.
Okay. So is it fair to say, I won't speak for OCC, although I did 10 days ago or whatever. So I think I maybe understand theoretically, I can understand kind of conceptually, there may be a concern with, in some circumstances, with accelerated depreciation, right? Like if you have an asset that under traditional rate making principles might be assigned a 50-year life, assigning a 15-year life, all else equal, is going to increase depreciation expense. I guess I'm just asking, similarly, theoretically, though, an asset that would, under traditional rate making principles, be assigned a 2-year life is going to have decelerated depreciation in the same way. Am I understanding that correctly? In other words, ratepayers will pay for that otherwise 2-year asset over 15 years and have an all else equal decreased depreciation expense impact.
Conceptually, I think that's exactly right. Sitting here, we're not aware of too many examples of capital projects that would fall into that bucket, but conceptually that you're spot on. I would also add that at GennConn, like I've said, GennConn has 2 peaking generation facilities, and we do capital projects to allow GennConn to continue operating. So if, to just pick a somewhat ridiculous example, if GennConn were to install a pole that you would expect to last for 70 years, well, maybe the wood would last for 70 years, but it's only going to be useful to GennConn during the life of GennConn's operation. So I think that's the thinking behind the staggered approach to depreciation we discussed.
Thank you. And sorry again for interrupting.
All right, thank you. No, it's okay. So moving back, I was referring to OCC 24 answer, and this relates to ownership. Just let me know when you have it.
We're there.
Okay, great. So is it correct to state that Alpha Generation provides maintenance to the Deval and Middletown plants as a separate party, which does not have an ownership stake?
That is correct. Alpha Gen does not have an ownership stake in GennConn. No.
Okay, follow up to that. Just to be clear, the owner of the plants does not also provide maintenance to the plants.
No.
Okay, good. So I'm gonna move to maintenance now. So I'm gonna refer to OCC 21 and OCC 21 attachment 1.
We're there.
All right. So I'm glad the company provided the manual here. So to be clear, the company staff consults with the manual on a regular basis to maintain the equipment, correct?
Correct.
Okay. And does the company ever not follow the equipment manual?
The only way that would happen in event, with like a relay that, a NERC requirement that would require it to be sooner than an OEM, requirement. We'd have to follow the NERC requirement.
Okay, I understand that. That's good. So we'll move to another section here, which is taxes, property taxes. You scroll up. So referring to OCC 1 answer, OCC 1 attachment 1, and OCC 11. How or has the company considered challenging its tax assessment to seek a lower tax rate?
So OCC 1 refers to the GennConn Devon facility and its agreement with the city of Milford for the life of the asset for taxes. So that agreement is in place, has been in place from the get-go, and this is the schedule that we follow associated with property taxes for GennConn Devon.
Okay,
Mhm.
so I'll take that as a no.
Objection.
Mhm.
It's not what Mr. Patel said.
All right, understand. Could move forward. Is the company aware?
Recognize the objection sustained.
Thank you.
Okay. Is the company aware of any legal remedies to tackle the high tax burden?
I would say no, but same answer.
And again, just subject to the fact that Mr. Patel and Mr. Hurwitz, Mr. West, and Ms. Dorsey are not attorneys and can't speak to any.
So as I'm hearing the previous answer that the agreement with the town of Milford and the company is not a tax, but an agreed upon assessment in lieu of tax.
Just one moment.
And consequently not subject to further tax changes for other regular Milford taxpayers.
So thank you for the patience. I think as Attorney Vaughn said, I'm not a lawyer, nor are any of my co-witnesses here. However, in reviewing this document and based on my understanding of what occurred at the construction of the facilities, the company entered into an agreement with the town of Milford. I've heard the term payment in lieu of tax or pilot before. I'm not sure if this is exactly that or slightly different, but clearly this is a long-term agreement through at least the year 2040. I see on page 4 of this agreement that governs the amount of tax GennConn would pay for the facilities. And I don't know if the term bad faith would technically apply if we tried to retread this agreement 15 years in, but I could imagine folks having some concern if we were to try to go back on our word on a long-term agreement that GennConn had executed.
So is it fair to say that an agreement between the parties essentially and originally was to stabilize in lieu of tax, actual tax charge with the agreed upon assessment that currently is in place?
That would be my understanding. And again, with the caveat that I wasn't involved in the execution of this agreement, you could see benefits of that arrangement from all sides. You could see benefit from the town because it guarantees revenue in a predictable way over a long-term period. You could see benefit to GennConn because it means a predictable expense that could be reflected in financial models. And you could see benefits to ratepayers because you have stable costs over time and not significant fluctuations.
Thank you. I'm all set. Thanks.
Thank you. So just a follow up. So the units I believe they're in Milford and Middletown, so there's two different towns that we're dealing with, correct?
Yes, correct.
Okay. So all your property taxes, are they subject to this agreement, which is one agreement?
No, GennConn Middletown has a separate agreement with the city of Middletown.
Okay.
Mhm.
Okay, so OCC 1, attachment 1, page 5, section 6. It's labeled reopener review, periodic review, deferred tax payments. Can you explain what this periodic review is?
Subject to the same statement / objection that they're not lawyers to interpret the contract. I think they can try to provide their response.
Yeah, to the best of their understanding.
So I've said a few times now that I'm not a lawyer. I think the importance of that caveat is about to grow significantly as I try to read this contract, but I can't help but notice that this section you've pointed us to includes the term reopener event with all the first letters capitalized. And if you go to pages 3 and 4 of this document, it defines the term reopener event as a series of things, including a material amendment or termination of the CFD, the extension of the term of the CFD, an acquisition that results in a cumulative 10% increase or decrease in the capacity of the facility, or any event described in section 8 hereof occurring on one or more occasions that result in a cumulative 10% decrease in the capacity of the facility compared to its capacity as of the last reopener event, or an increase or decrease in the CPI by 24% within any 3-year period.
All right, thank you. I just got legal counsel here. So, all right, to the best of your knowledge, are you aware if there has been a periodic review or a reopener event that's occurred during the length of this contract?
I'm just going to object to the extent that they're not lawyers to interpret the contract on the fly, I think is somewhat inappropriate.
Yeah, I think we're hitting the edge of what I can comment on. I'm not aware, but I am not a lawyer.
Okay, I understand that. Thank you. So we're gonna move forward. Is the company incurring any additional fees when it pays its property tax to the city of Milford or the city of Middletown?
I'm not aware of any other additional fees.
All right. So I'm gonna refer to OCC 12 attachment 2. Just let me know when you're ready.
I'm there.
Okay, great. Am I correct to state this is an invoice to Eversource for GennConn's Middletown's tax bill?
This is the invoice from Eversource for the transmission GIS taxes only.
Okay, thank you. Referring to OCC 12, attachment 1, is the remit for tax payment $1,684,050?
That's one component of the property taxes as defined by the agreement that we have with the city of Middletown, similar to Devon.
Okay, same reference here. Is this the tax payment for a 6-month period?
No, it's an annual.
Annual, okay.
I will note that City of Middletown has two taxing components. One is the city itself, and then there's a fire district and separately taxed.
Okay,
Mhm.
that may explain a follow-up question, but I'm gonna pose it to you. Why is this number from OCC 12 attachment 1, which is the $1,684,050 different from the last paragraph of OCC 12's answer, which is $1,885,700?
If I could just, where in attachment 1 to OCC 12 did the first number come from? Just what page?
Okay, let me bring it up.
Page 1. It's just a single page. Attachment 1, OCC 12, attachment 1. Blurry. Just saying.
It's a little blurry, but there's one paragraph.
That number, Mr. Apollonia, in your original question, was that $1,684,050?
Correct.
Thanks.
Apologies, I was looking at attachment 2. There we go.
And just so I'm following along, we're comparing that to what number on the narrative response to 12, OCC 12?
There's a last paragraph and the number is $1,885,700.
Thank you.
Don't see that. Oh, nice. Yeah, got it. Okay.
Just repeating your question again, we're talking about the 1.6 versus the 1.8 here.
Yes.
So the 1.6 and the GennConn attachment 1 is really a letter that we receive, probably not routinely as we would normally, by the city of Middletown for their portion of the tax, which is the 1.6. As I indicated before, the agreement with the city of Middletown has two components. The second component is the fire district. And the difference between the 1.6 and the 1.8 is the fire district tax.
Oh,
All right, that's good.
Mhm.
So I'm going to refer to OCC 12, answer section 2. To the best of your knowledge, am I correct that the company is saying the GIS property expense is impacted by Middletown's mill rates?
I'm sorry, I didn't hear your question completely.
Oh, yes, I'll repeat.
Mhm.
So I'm referring to OCC 12, answer section 2. Am I correct that the company is saying that the GIS property expense is impacted by Middletown's mill rates?
Yes, correct.
Okay. A follow-up to that, when was the last time Middletown's mill rates changed to the best of your knowledge?
I think we can probably provide some detail on that. I think year over year, there are adjustments to the mill rate that we assume for these taxes going forward, but until we get the bill, we don't really know, what that is. But I believe we have a schedule that kind of, Eversource actually provides us with a schedule that says this is what they're assuming for GIS taxes.
Okay.
Mhm.
So to the best of your knowledge, is it correct to believe that a mill rate change can lead to an increase in property taxes on GennConn?
Yes.
Okay, and to that, do you have any strategies that you have that you can go argue against the increased property taxes?
So I think your question was with respect to the mill rate. To my knowledge, the mill rate gets set by the town and is not something that the company can challenge or would be extremely difficult to challenge. What I have seen done from time to time, not in the case of GennConn, but utilities have filed, I think they're called abatements, or they request that the assessed value of their property changes. That is a pretty expensive undertaking. You typically have to hire an appraisal and then go through some significant litigation, and there's no guarantee that you're going to win at the end of that. So for the amount of this property tax bill, that strikes me as unlikely to be worth it.
I understand that. Thank you for sharing. That's all the questions I have.
Commissioner Beecher?
Yeah, can I add a quick point? There is a difference between a property tax rate millage and a payment in lieu of taxes agreement, correct?
Yes.
And so as a corporate citizen, like any citizen, you are within your rights to have a conversation without necessarily being, characterized as a bad faith partner in the community. It's a conversation you could have, given that ratepayers, including ratepayers who reside in these communities, are ultimately paying for this, correct?
I presume a conversation would be fair play.
Not necessarily an easy conversation, but it's okay to have a conversation.
Well, it depends how you frame it, I guess,
There you go.
what you're asking for.
Right.
But I would think if we are seeking to amend the terms of a 30-year agreement that was executed at the inception of GennConn, I would, to put it mildly, I would have questions about that.
Sure. 30 years is a long time. And both millage rates and property values have changed a lot over that time. So it's just something to throw out there. Thank you.
Thank you.
Thank you. Mrs. Zablosky, you up?
Good morning, everyone. First, I'd like to follow up on some cross from Mr. Capozzi and Chair Wheel on the SCR liability. Would you generally agree that for a regulatory liability, current rates should provide to recover costs that are expected to be incurred in the future, with the understanding that future rates will also be reduced should those costs not be incurred?
Could you ask that again, please?
Sure. Would you generally agree that for regulatory liability, current rates should provide to recover costs that are expected to be incurred in the future, with the understanding that future rates will be reduced should those costs not be incurred?
I don't think I can agree with the statement that you've made. I think in theory, you want customers today to pay for the costs that they are causing to be incurred. So to pick up the example of cost of removal, just conceptually, if there's an asset with a 30-year life and an expected $100 cost of removal at the end, you wouldn't want rates today to reflect that full $100 cost, which I think is the logical implication of the way you phrased your question. Rather, you would want customers of today to pay for their portion of that cost at the end based on their usage of the asset.
Thank
In
you.
other words, we're trying to follow the principle of cost causation. We'd like customers of today to pay the cost that they are being incurred in the provision of service to those customers.
I'll take that. Following up on Mr. Capozzi's questioning on the increase in the liability, I believe you mentioned CPI. Does that track well with the increasing cost of SCR replacement?
As we discussed to some extent earlier, the cost of SCR replacement is a one-time thing for the company. We have not incurred any cost for that to date, so I think that's a difficult question for me to answer, unless I'm misunderstanding what you're seeking.
No. Okay. You've also outlined the risk of GennConn being short. Is it possible that there's also a risk to the ratepayer of that amount being too high as well?
It's certainly possible. That could go in either direction. I think the way you said it, risk to the ratepayer, it kind of gets back to the exchange I had with Chairman Wheel. Congratulations, by the way, if I haven't said that before, that we have not contemplated how that over or under would be addressed, but we would presume that would be addressed in the appropriate revenue requirement proceeding as GenConn is approaching the end of its life.
So the company doesn't have a better adjustment to increase the value for that replacement, I guess, than just CPI currently.
Well, there is no better. We're following the contract for differences, which spells out exactly how this should be calculated. When we go to calculate the revenue requirement, we use the 5% capacity factor assumption as described earlier, but the amount that is recorded on our books on a regular basis is a function of the contract for differences. So it would be difficult to make a change without also amending that contract.
Thank you. Okay. And I apologize because I couldn't hear at the beginning. I believe the mics were off. Due to the UI rate decision, what is the updated ROE for GenConn? West.
$10.025.
Thank you. Please refer to RRU 21. And on the second page of this interrogatory response, in regards to the working capital facility, the company stated initial issuance, I'm guessing costs, are minimized through the issuance of proposal requests from multiple banks to obtain the least cost option. How many proposals has the company obtained?
So just recalling the last time we actually did this, it's usually a 5-year period that we have a working capital facility, so it's renewed every 5 years.
Okay.
And our treasury group actually issues the interactions with the banks and gets the proposals. And I believe the last time we went through this process, we spoke, and I'd have to confirm, it's subject to check. It's probably at least 3, if not more. Yeah.
So, and has the company always chosen the lowest cost option?
Yes.
Thank you. Okay. Moving on, please refer to GenConn 2, Exhibit 5, Work Paper B-4.0, page 1 of 2, tab. So it's Exhibit 5, Work Paper B 4.0, page 1.
Is that the original GenConn
Yes.
2 or as updated in
Original.
RRU 35?
Original, please.
Exhibit 5 is where you lost me. What was the next part?
Work Paper B 4.0, page 1 of 2.
Thank you.
Four point oh, page 1 of 2.
Yes.
Yep.
And this exhibit is allowance for working capital, fuel and spare parts inventory. Okay.
You're there?
Thank you. So the company lists the 2025 price per gallon as $2.64, I believe here.
Yes.
Okay. Now, what is this price as of? Date.
Give us a moment.
Sure.
It may just take us a minute. We could do that via read-in if
Okay.
there's going to be much more questioning.
I I have like two more questions on this, so maybe we'll just continue.
We'll see how long it maybe.
So that question was a read-in B, right?
B, right? Okay. So read in B, when is this the price as of? I guess the date. And so my next question related to that is, how is this amount calculated, or what is it based on?
Could you please just repeat your exact question?
Sure. So it's essentially, how is that amount arrived at? How is it calculated? What does that comprise? Just
It reflects a calculation based on heating oil futures, and the answer to your prior question, read in B, this is as of May 2025.
oh, May 2025. Okay. As a late filed exhibit, can the company provide an update to the anticipated fuel costs
I'm sure. Yeah.
based on, the current futures or?
Yeah, we can provide whatever is most current as of now.
So that calculation at that point, I guess, include anything actual plus the futures for the remainder of the year, or am I in the wrong year, I guess?
I would need to think about that, but I think I understand what you're seeking and we
Okay.
can provide an update to this.
I don't, so mind repeating, just what the late file request was.
Okay, so late file request would be just an update to the 2025 price per gallon. And
Per gallon of fuel, thank you.
yeah, fuel.
Got it. All right, thank you, appreciate that. Late file number E.
Just to say it back to you to make sure I've got it, you're looking for the equivalent of the $2.64 based on the most current information that's available.
Yes, and just
To the extent that includes actuals or
actuals
predictions.
plus, yes,
I understand.
thank you. Okay. Same exhibit, one tab over, so work paper B 4.0, page 2 of 2. So this exhibit again is allowance for working capital, fuel and spare parts inventory. So just going through the listing here, I noticed several instances of the source section would mention vendor quote minimized by O&M service provider operating expertise, end quote. What does this mean in this instance? Could you explain?
Yeah, so this number, and when we talk about vendor quote, is anything added to inventory is usually the result of a vendor, quoting as well as purchasing and putting into inventory is what that kind of refers to. But it also kind of incorporates
our O&M service providers experience. And if we had to utilize, some of this spare parts or whatever kind of thing, it's really based on their understanding of what the market is for some of these spare parts or components. Yeah.
Sorry.
Mhm.
So I think you've lost me after the quote,
Yeah.
the quote part. Like, how are these amounts changing based on the knowledge and, based on industry knowledge and vendor discussions? So the vendor discussions could be like price quotes and stuff like that, but then the part where you're saying it's minimized by O&M service provider operating expertise. I'm not sure I follow how that would affect the price necessarily.
Yeah,
If we're talking about quotes.
I appreciate the question.
Okay.
It's an important one because there have been instances in time where we've had to, as part of plant operations, realize that we needed to utilize, particular spare parts inventory, but based on the operator's experience, they may choose a different strategy to fix the problem, if you will, and convert, what potentially needs to happen versus what practically can be done.
Okay. That makes sense.
Yeah.
Thank you. If I look at the same exhibit, the first item listed under equipment, this is combustion turbines and generators.
Yes.
Okay. To the right of that, on the source column, it seems to state manufacturing pricing. Hold on, let me double check. Manufacturer pricing plus anticipated price increase. What was the original price?
Um, we'd have to check on that, but the presumption is whatever we purchased it for. And then eventually, when components in this particular category gets utilized, the assumption that there would be inflationary price adjustments necessary going forward.
So,
Mhm.
okay, so let me just follow up. How does the company arrive at this anticipated price increase?
Yeah, I would, characterize it and subject to check as just inflationary type of adjustments is what I would assume for that.
So inflationary pressures and,
Yeah.
okay, so.
Mhm.
But that is not explicitly anywhere in here, right? There's no calculation or how that amount is arrived at. There's no starting price as a point.
Yeah, I would just indicate that, getting to this number, we can submit in a late file, just as to allow us to.
And just, so, okay, we have a late file, which is the original price of that first item on the list.
I don't have the list.
Yep, it's combustion turbines and generators. Plus the calculation of how the company got from the original price to its current value in this exhibit.
So that reference is Exhibit 4B 4.0, page 2 of 2?
Correct.
And is that for clarification, Mr. Saplasky? I somehow already knew where you were going. I started typing out this LFE description while you were, it's almost as if we used to work together. Is that you're looking for the derivation of these prices, is that just for that first line item or for every equipment item on that list?
It's honestly for the first one because it's the only one that I believe that says pricing plus anticipated price increase.
Got it. Okay. Thank you.
If I could add, is there any anticipation of any decreases or any offsets? Or is it simply inflationary? If you anticipate any efficiency gains or opportunities to, to adjust downward, that's always good to know too. Thank you.
I'm so sorry, Chairman Wheel, just for clarity of the record, I believe it's Exhibit 5, Work Paper 4. I think we had said Exhibit 4. Just wanted to make sure that everybody's on the same page about what we're looking at.
Okay, but we're looking at combustion turbines and generators in the amount of $2,389,222.
Correct.
Is that also an exhibit? Because I'm looking at Exhibit 4, work paper B-4.0. That's also the first line item there.
You may be looking at the tab that's relevant to combined, and they may be looking at the
Okay.
tab that's just Devon, but we see the same number and can provide a late file illustrating the derivation of that amount and also commentary on whether there may be decreases that are relevant to Commissioner Beecher's point.
Okay.
That would be great. That was the one I provided was Devon only. So that's why. That's where the disconnect is. That is all from me. Thank you.
Thank you, Mr. Sabowski. Chair McEnany?
That's all for the OCC. Thank you.
Thank you. Commissioner Conti, any further questions? Chairman Wheel?
I do have one other area I was curious about. The pre-filed testimony talks about the basis adjustments for fixed O&M and raises, let's see, it's on page 21. There's this discussion of the sort of like potential for multiple prudence reviews for the same incremental O&M, fixed O&M costs. I think I understood that. And specifically, like there's a line on the bottom of page 21 that says the amount already deemed as prudent would be in excess of the unadjusted 2008 escalated capped expenses and therefore subject to prudency review again. Are these costs constant from one year to the next? Like I was specifically looking at one of them appears to be formaldehyde testing. Is that the same exact cost every year?
So for formaldehyde testing, it would vary year over year depending on, obtaining quotes from the various stack testers who would be coming in to do that testing. So it would vary year over year.
Okay. So the reason I'm asking is that I understand like where the company's coming from in the testimony, but my view of it is there's a difference maybe between pure sort of agreeing that a category of cost is appropriate to incur versus a review of, for instance, if there are multiple vendors, like shouldn't the regulator be able to review whether vendor selection was appropriate or whether there could have been a more efficient way to review the costs?
I'll start and then my colleagues can add as they see fit. I think what we're trying to communicate in this section of our testimony is that the decisions way back at the inception of GennConn established a threshold for O&M, just to make it up, $100 in 2008 that would then be escalated by inflation. And if we could run the plant for less than that, the presumption is we're doing a good job and those costs would be prudent. So to use an example, if the threshold is $100 and we operate the plant for 98, and then Pura comes along and says, well, $2 of that we think was imprudent, we're saying, well, you're doubly reviewing the prudence of that $2. If we come in over the cap, I think that's a different story. Then there's a series of words in various places about what we have to show about why we came in over the cap, but what we're trying to communicate in this section of the testimony is if we come in under the cap and then those under the cap costs are reviewed for prudence, that review has occurred twice. Once when the threshold was established way back in 2008, and now again in this revenue requirement proceeding.
Okay, so is that kind of, I'm familiar with this concept because it's sort of the same concept as a base revenue requirement, right? Like in that you set that, you get to a, like in an electric distribution company rate case, you establish the revenue requirement and you establish that by building up of all the expected, by an individual line item review of costs. But then once you set it, there is no retroactive, wait a minute, you said this line item would cost X and it turned out it cost Y. So is it a similar concept except with respect to if the cap is exceeded?
I think that's close. I might say it slightly differently. So just to build off of that example, if, for example, an electric utility had a recently completed rate case that established an amount of O&M, just to call it $150 million, and then that utility goes in again for another rate case and then says, hey, now our O&M expense is 145. I would expect that in that second rate case, the 145 million would still be rigorously scrutinized. We would not say as an electric utility that, hey, well, you approved 150 million last time and we're coming in less, so we're de facto prudent. I think that would be a strong argument in support of why we have operated the utility efficiently, but I wouldn't, in the ordinary course, expect that to mean that that 145 is immune from a prudence review. I think the difference here is that's not exactly how things were set at the beginning of GennConn. To piggyback off of that example, I think what they're saying is if 150 was the threshold in 2008, well, we're going to escalate that by inflation each year. And if you do come in less, if you come in with 145, the presumption will be that that is prudent and you're doing a good job. And so I think it's a sanity check, if you will, that isn't typically applied in electric utility rate cases.
Thank you. Thank you. That's all said for me, but I think Commissioner Beecher's got.
Right, just a bit of elaboration, but so the concept of a fixed O&M is a bit of a misnomer in a way, right? Because conditions are dynamic. Over time, you know, we've got economic forces, we've got technological forces, we've got opportunities for the managers to find efficiencies. So, you know, the economists like to say in the long run, all costs are variable, even the capital costs, right? So I think that's at a general level, sort of the academic point, right? That it's great to see, you know, analysis of that going forward. So thank you so much.
And I think just to quickly comment, I wasn't here when GennConn was established, but I'm guessing the fixed versus variable has to do with not whether the costs are going to be literally the same year over year, but rather whether they vary based on how much the plant operates. I think there's some costs that clearly, like fuel, that clearly we run more, that cost increases. I think things like labor or property tax or what have you, to your points, obviously will change year over year, but that change isn't driven by, well, we ran at a 4% capacity factor this year versus a 2% capacity factor last year. Could there have been a different label? Of course, but I think that's what led to the fixed label.
That's a great clarification. In the short run, a lot of costs are quite fixed. I understand that. Thank you.
Thank you.
Thank you. Attorney Vaughn, would you like a few minutes to explore redirect?
Yeah, 5 minutes would be
Certainly.
perfect. Thank you.
Would be perfect.
Yeah, speaking of having said that table a long time. Because we see you're always like big. Yeah.
This one is. And buy anything more. But the room looks great.
Yeah.
Eddie Wires. He's from. So I said, what? That's not good.
Right, yeah.
This is great. I can hear.
You know, I.
Like what you said. Right. Yeah.
All right, let's go back in the record. Welcome back. And Attorney Vaughn, are you ready to redirect?
Yes, thank you for the latitude on the break. I have limited redirect. Mr. Hurwitz, do you recall cross-examination earlier this morning from the Office of Consumer Counsel on the change in depreciation rates being applied to the GennConn facility?
I do.
And could you explain more any benefits associated with that change?
Absolutely. So if hypothetically the contract for differences were extended for a period, say 10 years beyond what is originally contemplated, and at that point the assets were fully depreciated, the assets would not depreciate again. You don't continue depreciating. And so at that point, customers would benefit from fully depreciated assets continuing to provide service at no cost or no, return on or of the fully depreciated capital investment at that point, to say that more precisely. So that is one benefit of having assets that are fully depreciated at the end of the currently contemplated 30-year life of the facilities.
Thank you. And Mr. Patel, do you recall earlier this morning a cross-examination from the Office of Consumer Counsel regarding the tax payments associated with the GIS substation?
Yes.
And could you explain in more detail how those tax payments work?
Yes. So I think it's important to note that the transmission GIS facilities are owned by Eversource, and Eversource is responsible for the property taxes associated with those facilities. We receive a bill, and that's what we pay, but it would be Eversource's responsibility to continue to manage those costs correctly.
So it's not exactly a tax you pay, it's an expense you pay to Eversource to deal with the taxes any way they see.
Correct. And that was part of the original, construction of the plant, where the substation and the interconnection gets transferred over to Eversource. Yeah.
Thank you.
Thank you. Nothing further.
All right. Very good. Thank you. So let's turn to our schedule. Late file exhibits will be due November 7th. November's a busy month to you all. We will have late file exhibit hearing on November 12th, briefs due on the 17th, and PFD on the 2nd. So if there are no other administrative matters to address at this time,
None from the company.
all right, seeing none, then we stand adjourned. Thank everybody for participation.
Thank you very much.